Implications for Industry of the Trump Trade Policy. Ginger Falk is a partner with the law firm of Eversheds Sutherland. Hi, Ginger. Thank you so much for being with me today. Really appreciate it. Ginger, give me a brief overview of what new regulations and legislation we can expect from the Trump administration with regard to trade policy.
Yeah, thank you so much for having me. It's great to be here with you and your viewers. So, as previewed on the campaign trail, President Trump has gotten busy already in issuing new executive orders to impose tariffs, in some cases across the board tariffs targeting certain countries. On February 1st, he issued 3 executive orders that directed across the board tariffs on goods from Canada, China, and Mexico. Shortly thereafter, however, the president paused for 1 month the effective date of the Canada and Mexico tariffs, but the additional tariffs on China became effective on February 4th. And those aren't the only tariffs that have been announced or proposed. In addition, Trump has signed a presidential memorandum moving the United States a step closer to a reciprocal, what he calls a reciprocal tariff system. And that order could dramatically raise duties on imports from around the world. He is proposing to impose reciprocal tariffs to mirror the trade barriers set up by other countries. Then we have the steel and aluminum tariffs. These are what we call the Section 232 tariffs. And Trump has proposed a 25% tariff on all imported steel and aluminum to begin on March 12th, regardless of country of origin. And even that is not just this week. President Trump ordered an investigation of copper imports, that could trigger a process that could result in new tariffs on copper materials. And also he said that he intends to impose tariffs on the auto sector and on the pharmaceutical and semiconductor tariff, announcing the possibility of tariffs of 25%. So when you think about this and the huge implications of this from the perspective of global supply chains, with all of these different tariff actions, and think about the fact that each one of these tariff actions could then lead to retaliatory tariffs from the targeted country. You can see where this could really grind some supply chains to a halt while they figure out the implications and try to figure out how to manage their cost and profitability structures in light of these new costs. And that's going to have some important implications for how U.S. and importers around the world will structure their supply chains in order to mitigate as far as possible the tariff treatment of the goods that they're importing.
Okay, let's talk about some of those ways that these traders can, in fact, mitigate the impact of these new tariffs. Let's start with the concept of tariff engineering. What is it and how does it work?
Yeah, well, tariff engineering is really a fancy word for just maximizing your tariff treatment to reduce the amount of costs in your supply chain. And it's a strategic approach that businesses can use to legally reduce the amount of import duties that they pay. Usually when we refer to tariff engineering, we think about a method of changing the country of origin of a product by moving some of the manufacturing operations for that product to a different country. But it can also mean things like getting different types of materials, changing your harmonized tariff schedule classification, or even more micro kinds of adjustments, like taking a look at how you're valuing products in your supply chain, and are you really maximizing the value of that, or really minimizing the value as far as legally you can do that. And so since customs can only levy tariffs on the goods as they are imported, some of these activities you can take in the background can give you the opportunity to redefine your imported product and then pay lower duties on it. But I want to make an important note here, which is you can't simply reclassify the exact same good under a different harmonized tariff code. That would be evasion. Rather, your imported product must actually embody the country of origin that you're claiming. It must actually embody the qualities of the harmonized tariff schedule classification that you're claiming. So it's really important in that respect as you're engaging if you're engaging in the process of tariff engineering, to make sure that you're complying with the rules on substantial transformation, that you're complying with any rules of origin that may exist under a free trade agreement. And that's really crucial to make sure you avoid penalties.
So the harmonized code serves as a guide to what types of materials and ingredients you could switch to that are not falling under the most egregious tariffs. You use that in order to legally switch, as you say, although that seems like a rather long-term solution. I mean, you don't just overnight start changing the ingredients of a product, that you're importing. What about more about the actual shifting of supply chains, shifting of sourcing, diversifying sourcing? To what degree is that a way to get around it, given the fact that, I mean, at least at this point, there are not tariffs on on all imports. That may happen, but in the meantime, talk a little bit about how that's a solution as well.
Sure. So there's lots of different ways to improve your tariff treatment in your supply chain, short of changing the product that you're inventorying. One of the simplest ways is, if you're anticipating tariffs coming into place, is to increase your inventory before the tariff change actually occurs. So that allows you to avoid paying the higher fees for those goods that you already have in inventory. And then the next thing that we usually think about are country of origin changes. And this involves maybe not changing your whole product, but shifting where you're producing it or shifting where you're assembling it to a country with a more favorable trade agreement with the US. And that's where you need to make sure that if you're trying to do that, you have to ensure that the goods actually undergo a legal principle called substantial transformation in the new country. And that means that the product has to undergo a significant change in form, appearance, nature, or character. So, for example, if raw materials from multiple countries are processed and they're assembled into a new product in another country, that final product may be considered to have originated in the country where the substantial transformation occurred. Another way of tariff engineering is using the tariff mitigation that already exists in the customs regulations. So using free trade agreements where you can, shifting the manufacturing to countries that have a free trade agreement with the US. For example, we have the US Canada, Mexico free trade agreement that's going to be undergoing a review in 2026. But under that agreement, there are specific rules of origin that you're required to demonstrate the origin in a USMCA country in order to take advantage of those preferential tariff treatment. Also using foreign trade zones. These are secured areas within the United States that where goods can be imported into a foreign trade zone and they can sit outside of U.S. customs jurisdiction without paying duties until they leave the zone. And so just making sure that you're using those to maximum effect. Also, duty drawback programs, making sure that when you can claim refunds on duties that you've paid on imported goods that are later exported, make sure that you're doing that. And this can be really useful for companies that import raw materials and then manufacture products and then export the finished goods. They can claim duty drawback on those goods.
Yeah, good advice. I've heard over the years that not enough companies take advantage of duty drawback and even FTZs for that matter. Either they're unaware of them or they don't want to get into the complexity of it, but it certainly pays now, doesn't it, to at least explore
Yeah, I
those
think
options.
that's true, and it's probably because companies have outsourced their customs policies and procedures to the brokers, to the import brokers, and the import brokers, their job is to make sure that the imports are complying with the duty requirements and complying with the customs entry requirements. Their job is not really to make sure that companies are paying as little as legally possible for tariffs. So that's something that a company needs to initiate
Mhm.
in its own supply chains and really look at optimizing those supply chains for the best tariff treatment. And so that's really something, there's a lot of things you can do. I didn't mention also looking at your valuation methodologies. They're typically the way that a good is valued for duty purposes is based on the transaction value. But there are some other rules out there, like the first sale rule, and transfer pricing, and exclusion of international freights, things you can do that if you can take a close look, item by item, of the what goes into the value of your imported product, and see if there's a way that you can either use the first sale model to value it at a lower price, or exclude some of these post-import
Mhm.
import expenses and international freight expenses that can be
Yeah.
eliminated from the valuation.
So there are a lot of tools in the toolbox, it sounds like. I mean, one of them, the most obvious, let me just finally ask you, I mean, what about the possibility of simply bringing it all home? Domestic production, domestic sourcing, you don't pay tariffs at all. Not as simple as it would sound, but is it an option to at least look at?
Well, sure, and that's often the intent of a tariff action, is to encourage more companies to onshore production. Of course, that's a big decision to make if you're going to make an investment in new U.S. manufacturing facilities. I think you wouldn't want to do that on the basis of a tariff that has just been sprung on and may then be removed just as quickly.
Yeah.
Looking at how rapidly changes can happen under this administration, I think you want to, before making a huge investment like that, to think about the permanency or the chances that the new tariffs could be removed based on bilateral negotiations between the U.S. and the target country. So since there's a lot that would go into thinking about that, but certainly onshoring is an option. The other thing that everybody can do, and that doesn't require a huge investment of resources, is to do a supply chain review of your supplier contracts and your customer contracts, and think about the impacts that tariffs will have
Hmm.
under the new tariffs will have under those contracts. Is it clear in your agreements who's responsible for paying tariffs? Who is the importer of record? Is a massive change in pricing brought about by a change of law that leads to a tariff? Is that considered a force majeure under your contract? What are the implications? The other thing, and a lot of your viewers will have seen this during the semiconductor chip crunch that we saw during 2019 and 2020, is that you see a lot of suppliers who are going through liquidation, who have delayed shipments, and just tariffs, the kind of tariffs that are being proposed by this administration threaten to bring a lot of disruption into supply chains. So it's very, very worthwhile, if you haven't done so already, to look at those contracts. I've have clients who set up a war room just to look at the way that these tariffs may affect their suppliers down the line, and should they be looking at diversifying suppliers, or taking any other actions that they can legally take under those contracts. At the end of the day, it's a lot of this has been said before about building diversity in your supply chain, building resiliency in your supply chain, and that means diversifying, and it also means engaging in regular and high quality communications with your suppliers about the impacts, the predictable impacts of the increased tariffs.
Well, the one thing we do know for sure, and that is the uncertainty and the disruption isn't going away anytime soon. So, Ginger Falk of Eversheds Sutherland, thank you so much for sharing with us some of these things that traders can actually do to mitigate the impact of what's going on right now in the world of international trade and U.S. trade policy. Thank you very much for being with me today. Really appreciate it.
Thank you.